The market has moved already, Barry, and so the question is, has the train left the station, and where are the opportunities at this point?
No, I don't believe the train's left the station. I think we've got several hundred more points of upside on the S&P between now and the end of the year. And then into next year, the outlook's pretty optimistic. I mean, when I set my strategy and tactics coming into the election, what I told all my clients was, from a tactical perspective, the market's likely to rally under almost any scenario, a blue wave scenario, Trump and the Republicans holding the Senate, or the scenario that we just got. But that once we got into 2021, if we had the blue wave scenario, we'd likely get a buyer's remorse related sell-off. And that would be related to the nature of stimulus. This idea that we'd get a monstrous amount of stimulus, would carry the markets on a sentiment basis for some time, but then it would actually impair the recovery, much like the 2009 American Recovery and Reinvestment Act did. This scenario is optimal because, for me, the best case scenario was that the Tax Cuts and Jobs Act remained in place, right? And the driver there was, we had already the economic conditions for rebuilding of our manufacturing base, a big capital investment boom in physical plant and structures. It was somewhat impaired by the trade dispute between U.S. and China. But once we got past the election, if the Senate remained in place and we didn't reverse those tax cuts, we were going to really start to invest in those sectors and have something of an infrastructure boom, but not one driven by the government, one driven by the private sector. So for me, yes, we got a big move in tech yesterday and a sell-off to some extent in industrials, financials. But I think the industrial sector and the material sectors are the ones that have serious upside well into next year.
So that's where you'd be putting your money right now?
For sure. I mean, listen, I've been overweight tech for a decade or more. I downgraded it in August to market weight, took communication services to a bit of an underweight. I removed that after the big sell-off. I wouldn't be any more than market weight those sectors. I know you guys had an earlier discussion about antitrust, and I think those risks will grow, will evolve somewhat. This is sort of down your alley, Andrew, from consumerism towards structuralism, the idea that just being too big creates risk of untoward anti-competitive behavior. But that's a slow evolutionary move. I do think that the benefits of the big move to the cloud and digitization will start to accrue more to the consumers of that technology from the producers. So all these are evolutionary things that imply that tech won't have the level of outperformance in the 20s that it had in the 10s. But I'm not ready to actually short that sector, get out of it. I just think that you're going to have a much bigger move in industrials, materials, more cyclical sectors. Healthcare could be a big beneficiary here if we really take a huge expansion of the government off the table. And keep in mind, with a Republican Senate, those cabinet appointments, some of the fears people had of, various warriors for the Green New Deal or a public option, those have to be approved by Mitch McConnell. He's not going to do that, right? We're not looking at gridlock from here. We're actually looking at bipartisan appointments and legislation. So for me, this is a much better outcome that removes a lot of the tail risk.
Shepard Smith here. Thanks for watching CNBC on YouTube.